Hello and welcome back. Let's go across to an exclusive interaction with none other than Jairam Ramesh of Piramal Retail. My colleague Ajay got a chance to speak to him.
We are issuing, as you rightly said, we are opening our maiden issue. It opens on Monday, the coming Monday, and will be open till the Friday the week after. It's an issue for 200 crores with a green shoe of another 800 crores. So we could go all the way up to 1,000 crores, depending on what we see in the market. We are offering, as you rightly said, attractive interest rates for people who are interested. The interest rates go from 8.1% at the low end to about 8.99% at the high end. So, and we have 5 different tenures, 2 years, 3 years, 5 years, and 10 years. So there are 5 different options there, etc. So it's a really good offer. It's the first time that we are doing a public NCD, and hopefully we will, we will get a good response from the market. What's happening right now in the market is that, we are seeing demand for credit starting to come up, particularly on the retail side. As the second wave recedes, we have started to see demand start to come back up, and we are hopeful of making use of that increased demand, and we have a strong presence today in businesses like affordable housing, mass affluent housing, small business financing, used cars, etc. And we plan to expand that in the times to come, and that's what this NCD will be one of the foundation stones to help us do.
Right. Jairam, there is, I understand a retailization which is happening in the company, not only by a renewed tech-backed focus on the retail end of the business, which you are building, but also and sourcing funds from the retail side now, but also at the loan book end of the overall company. Now the DHFL piece comes in as and also retailizes the book, which was tilted earlier towards wholesale. Talk to us about what big parts of retail into the business, both from sourcing of fund side and on the bigger contribution on loan book on retail side does, because you understand retail very well, how it can change the complexion of the company. What are your thoughts on that?
Yeah, that's a great question, Ajay. The way we are thinking about this is Piramal has been in the financial services business for about 12 years, right? But almost entirely on the wholesale financing side. What we saw over the last 2-3 years, was very convincing evidence that says that you've got to have a much more diversified book, first of all, and a much more granular book, because a granular book is easy to predict. Markets are happier to fund it and deal with it, etc. And that's what our retailization story is all about. We are trying to grow retail both organically, which is what I've been focused on doing in the last 1 year, and we have been now live in the market for the last 6 or 7 months. And now with the acquisition that you just spoke about, that also adds significantly to the distribution muscle that you have. Having a retail business, which is today at about, by the way, about 10-11% of our overall business, but we have stated this publicly in the past, so I can say so again, is we have said that in the medium to long term we want to get that to about 2/3 of our overall book being retail. And for that we believe that a lot of opportunity exists in small town India, mid-town India, in terms of growing products that are very important in these markets, but are not necessarily the most important products that banks tend to focus on, right? So there is a lot of opportunity for NBFCs to go in there and serve these markets. There is a dearth of large NBFCs in the market today compared to where we were a few years ago, when there were 13,000 NBFCs in the country. Today there are barely 7,000 NBFCs. So NBFCs have practically come down to half of what they used to be a few years ago. And the large NBFCs, many of them have gone off the map, and that's the opportunity for someone like Piramal with a strong capital base, a strong brand, and hopefully in the near future a strong distribution network to go in and actually build on the retail side of the business.
Jairam, I'm also, of course, we are aware that some of your other colleagues from Axis are also joining in, apart from high quality technology talent from Amazon in the company. I want to understand what's the role of technology as an enabler, as a platform for this deeper penetration which you're also trying to achieve in rest of the country, from pure metro-centric approach to tier 2, tier 3, tier 4, and how will retail play a role in the way business model you guys are imagining together at the team level?
Right. It's another really important and interesting point. Tech is no longer a support function in financial services, right? Tech is a core product, and so we need to have a lot of the basic capability to participate. But the one good thing is the overall tech architecture in the country today and the public infrastructure that's available for tech today is fundamentally different from what was available even 5 years ago. Forget 10, 15, 20 years ago, right? So if we are starting a new business today, you have a foundation which has UPI in it, which has the Aadhaar infrastructure in it, which has the upcoming OCAN and account aggregator framework, etc. in it. And this allows you a very different kind of tech build than you could have done even a few years ago. And that's what we are attempting to do, is to actually own technology and not outsource it, and put together a very high quality tech team, which we are trying to do. We are setting up a very large tech center of excellence in Bangalore, which is where our entire tech team and our analytics team is based. And we are trying to use it to come up with personalized products, which are going to be important for the customers in small town, midtown India, whom it's very hard to just sit here in our AC offices in Bombay and try and understand what's going on there. And serve them in a way which is cost effective, and tech allows you to do that at scale.
Jairam, you have a good pulse on the retail end of the segment. There was fear a couple of months back that because of the successive wave, the second wave and third wave also, the loan book quality of the lenders which are really catering to tier 2, tier 3 or retail would be at big risk. But if a small finance bank numbers coming out of Rajasthan yesterday were any guide, it has kind of allayed a lot of fears of that sort, and entire retail centric or tier 2, tier 3 centric finances have become excited. What are your thoughts on this particular factor, which seemed to have become a big concern, but now perhaps people are realizing that retail delinquencies perhaps may not rise as much as people thought or the street thought? What are your view on this fear?
So I'd say that even bankers are a little bit surprised, to be honest, right? Everybody's surprised at how robust the risk performance has been. Even a year ago, if you had asked me the same question, I would have given you a lot more of a doomsday answer, saying a lot of bad stuff is going to happen. Uncertainty is very, very high. The employment pattern of a lot of customers has gotten destroyed, and so on. And some of it has borne out in the sense that some businesses have indeed had fairly significant impact on themselves, and continue to have with partial and complete lockdowns in many parts of the country. So that does continue to affect. But what we have seen is a rundown of savings, etc., of these customers, but they have continued to be good on loans to a larger extent than people imagined. You should still expect, by the way, that risk metrics of financial institutions will probably look a little bit worse in Q1 compared to what they did in Q4. But it's very unlikely that you are going to see the kind of thing that you saw, for example, in Q3 of last year, when there was a big bump up in NPS all across the board right after moratorium ended. Why has the impact been lower, particularly in unsecured? Everybody thought unsecured was just going to blow up, right? But it hasn't. And why it hasn't, it's not super clear to me. But what I'd say is some of it has got to do with customers themselves being a little bit more aware, and things like credit bureaus, etc., increasing awareness. And a lot of it has to do with regulatory action. Regulators have been very proactive with things like moratorium in the first wave, and then with OTR schemes, both the first time and now the second time. So the regulators have given some short-term breathers to a lot of people, and of course the government has played its part as well in actually making sure that money flows through various schemes to the end consumer. So all of that has played a part: consumer discipline, government action, and regulatory forbearance. But I think you're absolutely right that the overall outcome has been much more benign for retail lending than people would have dared to dream a year ago.
Jairam, just one last question I need to ask you. Sorry for keeping you a little prolonged, but I want to understand from you on the demand outlook at the retail level. What is your sense when you speak to your peers across the industry or the research which you read around? Do you see demand to come back, or do you see the retail consumer will remain cautious for some time, say between now and the festive season? Do you see things recover, or people would generally remain cautious?
See, when the first wave had receded and second wave hadn't yet started, so let's say the first couple of weeks of March, if you look at demand levels at that time, that demand level had reached pre-pandemic levels, right? It was exactly at pre-pandemic levels in the first 2 weeks of March. And then second wave happened. In April, demand fell to half of what it was before. In May, it fell to half again of what it was. So by the time May came, we were at 1/4 basically, motamoti, of the demand that we had seen. So it was a much poorer 2 months. But since then, things have picked back up. In June, things are back up, but we are still not anywhere close to pre-pandemic levels. I would say that the industry numbers of June are still to come out. But my guess would be that the industry levels would be something like 70% of what March looked like. So demand is coming back for sure, and the bounce is very steep. It is much steeper than we saw in the first wave. First wave took a while, right? Even after unlock started, it took a while for demand to come back up. In the second wave, we are seeing a much steeper bounce back in demand. But when will it reach pre-pandemic levels, and when will it cross it? Right now, it doesn't look like in this. June certainly not. July probably not either. But August, September, I wouldn't be surprised if we were at pre-pandemic levels of demand.
That was an exclusive interview with the management at Piramal Capital, Jairam Ramesh, earlier, of course, with a banking name. On that note, we're taking a break. Coming back quickly, stay tuned.